Hi everyone. Today in this session, we are going to complete the first part of ratios chapter. Ratios analysis as a chapter is very easy to understand once you get a good grip over the first lecture on ratios. Ratios will be totally divided into two parts. Number one, understanding the concept and ratios. Number two, doing some 2-3 problems in that regard, a comprehensive problem. In examination, every time a same kind of problem is getting repeated continuously. Consistently, they will be asking the same kind of question. They will give you some information. Using that information, they will ask you to fill the uh, remaining unfilled information. Maybe in some questions for 8 marks, they will ask you to re-prepare a balance sheet. Easy chapter once you understand this particular first lecture clearly. First lecture will be concentrating totally on understanding various important ratios from the exam's point of view. And from the first itself, I am giving a disclaimer. Let's not waste so much time in analyzing the ratios as an exam oriented. What are all important? If you learn this, any question that comes in examination, you will be able to solve. So therefore, two things are very much required. Understanding what are all the ratios applicable for our exams and what are all the meanings of those ratios. Rather than understanding the formula, understand the meaning properly such that you can crack any kind of question that comes in examination in this regard. So first one, what is this concept of ratios analysis? Health of a company can be understood from three different kind of statements. Number one will be P&L account. Number two, balance sheet. Number three, cash flow statement. From these three things, we can easily diagnose the financial health status of a particular company. How a doctor diagnoses the health statement, okay, using our CBP like that. So complete blood report or report, etc., whatever is available. So in this particular regard, companies' financial health status can be understood using the ratios and analyzing them. First, let us understand what is the ratio. Ratio means comparison. Comparison of what? Comparison of my company performance from the last year and this year. When you compare, just don't compare the profit after tax. There are so many elements that are going to affect the company's financial health. What are all those things which affects the company's financial health is what we are going to analyze in depth in this particular area called as ratios analysis. So P&L and balance sheet both are the two statements which contains so many numbers which require a lot of interpretation. It is not just about reading a P&L or reading a balance sheet. It is all about interpretation of so many numbers. Reading P&L and balance sheet is actually an art of understanding the happenings in a particular company. So, I will first explain you the idea behind this chapter. Directly, I will jump into it. Listen. There is a company. There is a company which is having a profit of 1 crore. There is a company which is which has a profit of 2 crore. Which has a profit of 2 crore. So, one company is having a profit of 1 crore, another company is having a profit of 2 crore. I asked which company is better. I asked which company is better, 1 crore company or 2 crore company. Immediately, a person said that 1 crore company is not better, 2 crore company is better. 1 crore company is getting that 1 crore profit with 100 crore, say for example, okay, with 50 crore investment, and 2 crore profit is made by another company not with 50 crore. 2 crore was made by 100 crores, okay, 100 crore or 200 crores. 200 crores it made 2 crore, and this company has made 1 crore with 50 crores of investment. If you can understand, with 1 crore 50 crore of investment, I made 1 crore of profit. With a 200 crore investment, I made 2 crore profit. When you calculate the return on capital employed or return on investment, A is better than B. That means all the time numbers directly we cannot interpret unless and until we take that in the context. Okay, So the profits, whenever you consider profit, you should understand from the context of the capital you invested. Like that, every ratio require a proper comparison. So totally, the ratios are of three types. One is P&L based ratios, balance sheet based ratios, hybrid ratios. So let me first explain you what is a P&L based ratio. P&L based ratios are those ratios which are extracted from the P&L account. Example, gross profit ratio, gross profit by sales. P&L means trading P&L. Okay, gross profit by sales. From this, what you have to understand, gross profit is a figure that is available in P&L account. Sales is also a figure that is available in P&L account. So using P&L account, we can calculate a ratio that's called as a gross profit ratio. Next, there is another ratio called as a balance sheet based ratios. Say for example, debt equity ratio. Which ratio? Debt equity ratio. Debt by equity, or current ratio, current assets by current liabilities. So both these ratios are dependent on the balance sheet. So from the balance sheet we will extract both. Third one, return on capital employed. It's a hybrid ratio. What do you mean return on capital employed? Return by capital employed. Return means a profit after tax. Okay, capital employed means it is there in the equity side. Means equity and reserves and surplus is called as a capital employed. So from this, what we have to understand, there are three kinds of ratios. Number one is a P&L based ratios. Number two, only balance sheet based ratios, and third one will be hybrid ratio, which is a combination of the first and second one. Okay, so this is the first one thing we need to understand. And why ratios chapter? It is meant for two types of things. Comparison. Two types of comparison. Number one, intra-firm comparison, inter-firm comparison. Intra-firm comparison means our company will be comparing with our company with the past year. Last year, what is the ratio? This year, what is the ratio? Whether there is a progress or there is no progress, we can understand. Okay, that's the number one. Number two, inter-firm comparison. We will compare our ratio with the company doing a similar business. Competitors' ratios we will compare, and we will understand where we are going better and where we are going wrong. Okay, so therefore, try to understand. We can also have some other comparisons like a benchmark comparisons. Other than interfirm and intrafirm, there is a third type that's called as a benchmark comparison. That is also interfirm only, but in a different way. Therefore, I am not telling that separately. There are two types: interfirm, intrafirm. Intrafirm is within our companies last year and this year. Interfirm is other than our company. When I say other than our company, it can be any other company, or it can also be a benchmark rate like P ratio we will be discussing. Okay, so this is the first one. Next, simply in simple, if I have to tell, okay, ratios are tool to diagnose the financial health of a particular company. How a doctor will take the CBP, complete blood picture, and he will tell that these are the deficiencies, these are good, these are bad. Like that, P&L balance sheet and ratios analysis will help us a diagnosis for the financial health of a particular company. This is the first introduction that I want to put before you. Okay, as a document also I'm putting it before you. Just have a look into it very fast. If you want, you can take a picture. Okay, I won't put it for minutes together. Just 1 minute I will put before you the entire discussion whatever I have made. Completed? Now, see here. So we have completed up to here. Whatever the points that I discussed, I put it in the form of notes. Now, first, in 2 to 3 minutes maximum, I will first show you how the P&L and balance sheet look like. Everyone know this, but still, as a formality, before I start with this chapter, I will first fastly show you what is the P&L and balance sheet. And again, I will tell you, I'm putting the entire lecture from exam point of view. Means this is an exam oriented batch video. Regular videos we can make times more comparisons, analysis, etc., notes giving, everything we can do. But from the point of view of examinations, definitely 8 marks question if it comes, you will get definite 8 marks. That's my guarantee. You listen to this lecture, 8 marks pakka. Okay, 2 lectures. One lecture theoretical discussion. This is most important than the second one. Ratios chapter, anyone can do the answers properly. It is like a single entry system what we have done in accounts. Nothing great. Then what is a great here? Understanding the ratios, because sometimes in exam he may ask you to make comparison and give you a report on what this particular ratio is. Okay. At that time, knowledge only will help you to understand rather than just mugging up the formula. Okay. Let us continue. Format of balance sheet. Format of balance sheet. The first one will be called as equity and liabilities. Equity and liabilities. This is the first one. Balance sheet la second part will be assets. Okay. Third part will be the total. Let us see. Balance sheet. Shareholders funds. Share application money pending allotment. Non-current liabilities. Current liabilities. That's all. This is the total liabilities. Number one. Let us see what this is. Shareholders funds, share capital, reserves and surplus. Share application money is not the point here. Money received again as the share warrants. Money received again as the share warrants. So first, these two are important for our ratios chapter. Share capital, reserves and surplus. When I say share capital, equity and preference both will come. Share application money received but allotment not yet made. Non-current liabilities means long-term liabilities. Long-term borrowings, deferred tax liability, no more impact on ratios chapter. This is the schedule 3 format. Long-term liabilities, long-term provisions. Current liabilities. Current liabilities are 4 types. Short-term borrowings, creditors, trade payables, other current liabilities, provision for taxation, etc. Short-term provisions. Okay, next. Assets. Non-current assets, other than current assets, means fixed assets type. Property, plant and equipment. Tangible, intangible. Intangible is a intellectual property, therefore property. Okay. Work in process, development in progress, research and development, all those things also will come. Non-current investments. Non-current investments mean long-term investments. Deferred tax asset, like deferred tax liability, deferred tax asset here. Long-term loans and advances given by the company. It's a receivable for the company. Other non-current assets. Other non-current assets. Other assets. Cash, etc. Sorry. Other than the fixed assets, etc. Any other left out na other current assets. Non-current. Current assets. Current investments means short-term. Inventories. Stock. Trade receivables. Debtors. Cash and equivalents. Cash balance and bank balance. Short-term loans and advances we have given. Other current assets. Total will be 2. So the total 2 will be this one. Okay. So total 1 and total 2. Both if you match, that will be the total amount that we have to write here. Okay. So this is the balance sheet. Balance sheet, total 1 and total 2. 2 types of total we have taken. Hope up to here everyone understood. Okay. This is the primitive way of a balance sheet. Vertical balance sheet as per schedule 3. This is a schedule 3 balance sheet. Next. I have written some notes. Balance sheet consists of liabilities and assets. Liability is the source of fund. Assets are the application of fund. Means if you take a balance sheet, financing will be done here, investment will be done here. So with this only we will finance. So therefore, getting money is a liability, putting money is an asset. Okay. So two sources of funding will be there very popularly. One is the owner's money, being the shareholders' money. Another one is the borrowed money called as others' money. Owner's money is also called as equity. Others' money is called as debt. Equity, whenever I say, it does not include only equity share capital, it also includes reserves and surplus. Debt includes long term and short term, secured or unsecured. Everything will be included. When I say equity, equity means not only the share capital but also reserves and surplus. Debt does not mean only short term, it includes short term as well as long term. Okay, next. Sources of funds are used to finance fixed assets, investments, and current assets. Okay, the source of fund which is employed in the assets is called as capital employed. Sir, what is the meaning? I will explain. Whenever I say capital employed, this is one of the most important word in the entire chapter. Okay, capital employed means what? I raise money from debt, I raise money from equity. Both the monies whatever I raised, I will purchase some assets or not. Which assets you will buy? Fixed assets I will buy, current assets I will buy. Therefore, fixed assets and current assets are purchased out of the funds given by both debt and equity or not. Therefore, instead of writing debt and equity, I can also write it as fixed assets and current assets, because fixed assets and current assets are not coming from sky. Yeah? Somewhere financing has to be done. So the financing can be done in two ways. Capital employed means total capital employed, equity plus debt. Both of these are used in what? Used in fixed asset and current asset. Okay, fixed asset and current asset, or fixed asset plus current asset minus current liability. We can call this as a working capital. So the equity and debt will be used to finance two things. Number one, fixed assets. Number two, working capital. Okay, so the capital employed does not mean just equity plus reserves and surplus. It also meant to say in other side around, from the liability side you can tell that equity share capital plus reserves and surplus is the equity or capital employed. But from the asset side, if you have to tell, fixed assets plus current assets will also be called as a capital employed, because unless and until you have the capital, how you can buy fixed assets, how you can acquire current assets? Okay, that's the point. I'm putting this also before you. 2 minutes and 2 minutes each. Analyze this properly. Completed analyzing the balance sheet. Now let us start with analyzing the format of a P&L. Okay, P&L also has some elements, easy only. Let us complete it very fast. Okay, first one is a revenue from operations, means manufacturing, all other revenues whatever a company gets. Other incomes means commissions, etc., any other income, that will be the total income. All the expenses, stock purchases, etc., depreciation, amortization expense, other expenses, everything. After that, profit before extraordinary and exceptional items, tax expense will be deducted, profit will be coming. Last one will be the earnings per share. Okay, this is the format of P&L. Just give one fast look, 1 minute maximum time given. Nothing great to interpret in P&L. Just have a look into the P&L just for a minute. Understand what are the items are there. We'll directly go into the ratios. Completed analyzing. Next. So this is the format of a P&L account. So we now understood the format of a balance sheet and format of a P&L. So first 20 minutes we analyzed the basics. So summarize everything. Ratios is a concept of a comparison. Comparison can be of two types: interfirm comparison, intra-firm comparison. When you make comparison, you can make a necessary decision making accordingly, and you can know what your company is performing. Okay, for that ratios are very very important. This is what we learned in the first part of the first 20 minutes of this lecture. From now, the ratios analysis is going to start with. Okay, so one very important, capital employed means what? Two ways you can understand. Capital employed from the liability side, if you take equity and reserves and surplus and the debt, all the things put together: equity share capital, preference share capital, reserves and surplus, and the debt capital, all these things put together we call as what? Capital employed. When I say capital employed, you should include long term capital employed, not the short term capital employed. Okay, creditors, all those things we should not consider into the term called as capital employed. Capital employed always imply long term capital employed. Okay, this is the first one we need to understand. From this, first, how many kinds of ratios are there? There are totally six different kinds of ratios. How many kinds are? Six different kinds of ratios are there. Okay, let us see one by one. First type of ratio. First type, liquidity ratio. What ratio, sir? Liquidity ratio. Seeing here, let us see. What are the liquidity ratios? Current ratio, acid test ratio, or liquid ratio. Liquidity ratios are also called as short-term solvency ratios. What it is also called as short-term solvency ratio. Second one is a capital structure ratios. This is also called as a long-term solvency ratio. First one, debt equity, propriety or proprietary, anything you can use. Capital gearing ratio. Next one is a debt service coverage ratio. Activity ratios, capital turnover, fixed assets turnover, working capital turnover, debtors turnover, inventory turnover, creditors turnover. Next one, sales profitability ratio means profitability in terms of sales. GP ratio, gross profit ratio, net profit ratio, operating profit ratio, cost of goods sold to sales ratio, operating expenses ratio. Meaning everything I will tell. Okay. First, let us understand what are all the ratios, because ratios are sometimes practical question they will give for 4 marks. They will ask a theory question from this. Okay. More than enough the theory I am showing to you now. Theory means whatever the theory I am going to show in the entire session now. That theory is very important for your exams. Capital profitability ratio means return on capital employed or return on equity. Miscellaneous ratios, EPS, MPS, PE ratio, DPS, dividend payout ratio, retention ratio. Okay. If you want to take a snap, you can just take this. Mainly why I am telling you is we can't spend so much time in this what to say, this 1 hour lecture or 1 hour 20 minutes lecture. You can't spend so much time in writing or doing anything. Take a snap direct from your phone. Directly take a snap, you can understand. First, how many kinds of ratios are there? There are 6 kinds of ratios. Number 1, liquidity ratio, short-term solvency. Long-term solvency is called as capital structure ratio. Third one will be activity ratio. Fourth one is profitability. Then there are 2 types: sales profitability, capital profitability. Last one is a miscellaneous. Okay, I'm putting it before you. If you want, you can take a snap. Completed? So tell me, how many ratios are there totally for our consideration? 6 ratio. Short-term solvency, also called as a liquidity ratio. Second one, long-term solvency, also called as a capital structure ratio. Third one, activity ratio. Fourth one, profitability ratio in the 2 types: sales profitability, capital profitability. And last one is miscellaneous ratios. Now, how many ratios are there totally? 2 plus 4, 6. 6 plus 6, 12. 12 plus 5, 17. 17 plus 2, 19. 19 plus another 6, 25. Okay, 25 ratios are there. 25 ratios are 25 important for exam. Okay, other ratios are also given in the study material, but in problems they don't test those. So from the problems point of view, questions point of view, 99 out of every 100 problems will contain only these ratios. 1 or 2 new ratios will come, that we will learn when we are doing the problem directly. Okay, so first let us understand what are all these ratios and the meanings associated with them. Okay, now see here. First, what is the first type? Liquidity. First, let me explain what is a liquidity ratio. Liquidity ratios are those ratios which decides your short-term solvency. Sir, I didn't understand. Sir, liquidity ratio means current assets by current liability. Current assets by current liability. What does it mean? Current assets, okay, means short-term assets. Means current assets are those assets which will be immediately getting converted into cash. Those are called as current assets. Cash is a current asset because it is already in a cash form. Debtors is a current asset because they will get converted into cash. Stock is a current asset because stock will get converted into sales. Sales converts into debtor. Debtor converts into cash at the end. Okay. So within 1 year, generally conversion happens into cash. Those assets are called as a current assets. Current liabilities mean those which are to be discharged during the year itself. That means they can't wait for 5-10 years. During the year, you have to pay them. Those are called as a current liabilities. Current assets minus current liabilities is a working capital. We have already seen in the working capital estimates. Okay, now the point is why these profitability ratios? Why these liquidity ratios? Liquidity ratios are given in order to understand whether a company is a solvent company or insolvent company. People, when they invest in the company, they wanted to know to what extent this company is solvent. Means what? Is it in a is this company is in a position to pay its short-term liabilities or not? Like this, if I tell, no one will understand. I will use a simple example. I will take two people, Mr. A, Mr. B. Mr. A purchased a house. I have given the example also in the book. Please listen first. Mr. A purchased a house. House worth 1 crore by taking a loan worth 1 crore. Example, don't bring a real situation. How can they give 1 crore? 80% of the asset value only loan will be given. Over action? No. Let us understand this way. 1 crore is the house value. 1 crore I have taken as a loan. Now, I took loan. Mr. A took loan of 1 crore to purchase a house worth 1 crore. Okay, and the term is 3 months. Term is 3 months. First thing, why you took loan? You don't have money. If I have money fully, why I will go for a loan and pay interest unnecessarily? You took loan because you don't have money. Okay. But the term is how many months? 3 months. Means long-term asset called as a fixed asset, you have taken with a short-term loan of 3 months. Yes or no? That means in this example, what you need to understand, a long-term asset is purchased out of a short-term liability. Okay. That means after 3 months, the bank will come to me. It will ask me, pay my particular loan. For all practical purposes, I'm insolvent. Do you know why? If I have to pay the bank, first I need to have a cash. Since I don't have cash, only I have taken the loan. But you have taken a short-term loan. You should have used this for a short-term asset. You have utilized it for a long-term asset. Conversion of that long-term asset is very difficult. And moreover, if you have to pay to the bank, how to get the money? Yeah, you don't have money. You took the loan. You purchased a house. 3 months later, you have to repay. How you pay? You have to sell the asset again. That means if a company is in a situation of selling the assets to pay their short-term liabilities, such companies you should never invest. That means the current assets of the company should be used to pay its current liabilities, not long-term liabilities. Okay. For example, creditors came to me. They asked, Kaushangesh, pay my money. What I have to do? I should sell my stock and I have to get money. I should convert my debtors into cash and I should get money. I should use my cash to pay them. That means assets, land and building, plant and machinery should not be sold. Yeah. If you sell them, your production will stop. So therefore, there should not be a situation where your liquidity is at a stake. Means the liquidity of a company will be always generated because of current assets and current liabilities. Okay. That amount, that liquidity should be used only for short-term assets. Am I clear? Simply to understand. You went to a creditor or you went to a bank. You ask, I want 8 months loan. I want how many months loan, sir? 8 months loan. Okay. Short-term loan. I want a short-term loan. Why? It asked. I said, I want to immediately purchase some stock. That means with the short-term liability, you purchase the short-term asset called as a stock. 8 months after, this person will come to you to get the money or not. At that time, what you will do? Conversion of stock into cash is very easy, rather than converting a land and building into cash. Land and building into cash, if you convert, or plant and machinery to convert into cash, ready buyers are not available like what they are available for stock. Okay. Say for example, Apple company is there, or Indian company, let us take for example, Tata Iron and Steel Company Limited. How they are getting money? By selling their plants? No. They will get money by selling the iron and steel items. That means the iron bars or iron, raw iron, rubberized iron, anything. The iron, whatever the metal is there, that will be their selling point. They will sell it and they will get the money. They don't get the money by selling their fixed assets. They will get the money by selling their current assets. Am I clear or not? That means another person, Mr. A, I said, Mr. B. Mr. B has took 1 crore loan to purchase an asset of 1 crore. 30 years loan he kept, or 25 years loan he kept, 360 months loan he kept. That means long-term liability has taken in order to have a long-term asset. This is a correct way. That means short-term funds you should not use for long-term liabilities and vice versa. This is the answer of liquidity ratios, current ratio. Ideal current ratio, generally, you need not follow strictly. General ideal current assets liquidity ratio or current ratio is 2 is to 1. 2 is to 1. That means current assets should be 2 times your current liability. Next, acid test ratio, also called as a liquid ratio, also called as what ratio? Sir? Liquid ratio. Current ratio, liquid ratio. What is acid test ratio? In the current assets, we have taken the current ratio equal to current assets by current liabilities. But in current assets, cash is already a cash form. Debtors is immediately convertible. It is in my hand how to convert the debtor. Credit period is decided by me. Collection is also decided by me. How good I am in collection, that good the money will come back. Credit period, you are putting 8 months credit. You are only at risk. Credit period means it should be 30 days or 35 days. It should be. Okay. So debtors is also easily convertible into cash because credit period I will decide. Collection also it is in my hand. Second one, stock. Current assets means what? Current assets means cash, debtors, stock. Stock is one of the item where conversion of stock into cash is not in my hand here. It is in the hand of the sales. If sales happen, then stock get converted. And moreover, even if sales happen, credit sales if it happen, again it will get converted to debtors. That means when you compare three current assets, cash, debtors, and stock take more time to get converted into cash than the cash and debtors in itself. Am I clear? Therefore, liquid assets means cash plus debtors without having stock. So therefore, current assets minus stock is called as a acid ratio, also called as a acid test ratio, also called as a liquid ratio, also called as a liquid assets. Okay, I repeat once again. I repeat once again. Current assets are not that much easily convertible into cash. Cash is already in a cash form, no problem. Bank balance. Second one, debtors. Debtors period I will decide. Collection is also in my hand. That means excluding small amount of bad debts, debtor will get immediately converted into the cash form. But the stock is not in my hand. I have to sell the stock means readily customer should be there na, to buy the product. So that's a problem. So a company should have ideally 1:1 acid ratio. Means what? For every 1 rupee of capital, for every 1 rupee of current liability, there cannot be more than 1 rupee of current asset. Okay, or for every 1 rupee of current asset you have, not more than 1 rupee of current liability you should have. Okay, sir, you have said that current ratio means current assets by current liability. Liquid ratio means current assets minus stock, it will be called as a liquid ratio or will be called as a liquid assets. But in the denominator, why we are taking still current liability? Listen, stock, we have to convert that into cash. It takes time. But you can't stop the creditors, yeah. Can you tell creditors, a creditor, please wait, I will sell the stock, then only you come. They will not wait. That means my liability is same, but my asset is only getting postponed to get converted into cash. Therefore, those are called as liquid ratios, also called as acid test ratios. See this. So hope you understood everything. And last point is current ratio is always expressed in terms of number of times. Okay, number of times means current assets are 2 times the current liability, 5 times the current liability. Like that we will express it. This is liquid ratio. Okay. Okay. Next, long-term solvency, also called as a capital structure ratios. See, easy. Company should be solvent not only in the short run, but it's also in the long run. For that, we use long-term solvency. Now, short-term solvency we have seen current assets by current liability. Like that, long-term solvency means what? Debt by equity, also called as a debt equity ratio. Ideal debt equity ratio is 2 is to 1. Means maximum debt should not exceed 2 times the equity. Debt means long-term debt here. Equity we already know, share capital plus reserves and surplus minus miscellaneous expenses. Okay. So equity is also called as net worth or shareholders funds or proprietor funds. Okay, PSC is also deemed as an equity share capital. In this chapter, separately preference share capital will not be given. If given, you should assume that that is also as a equity. Completed. Next, propriety ratio or proprietary ratio. Equity by total assets. What do you mean by this equity by total assets? Equity by total assets means total assets means fixed assets plus current assets. Total assets means fixed assets and current assets. Mean total capital employed or application of funds. In the total application, how much application of fund belongs to the equity? Means equity share capital, reserves and surplus. Okay, that will be called as a equity or not. That means total assets of company are 100 crore. Equity is 70 crore. What does it mean? In every asset, 70% ownership is belonging to the equity. That means how much portion of equity in the total assets of this particular company. So total assets is the application of funds, and the ratio help us to clearly know how much a part of assets are financed by equity. That means in the total assets, fixed assets and current assets is there. In that, how much is financed by equity? Proprietary ratio. Capital gearing ratio. Capital gearing ratio means, try to understand clearly, gearing means a leverage. Leverage means an advantage. Gearing means a leverage. Leverage means advantage. You will get leverage advantage not because of equity. You will get leverage advantages because of high advantage for debt. Low advantage of leverage will be with preference share capital. Okay. Leverages chapter we discussed. Whenever there is a fixed cost is an advantage as well as disadvantage. If company growth is very high, then fixed costs don't grow. It magnifies the profit. Okay. So that leverage effect will be there only if there is a fixed commitment like interest, like preference dividend, etc. Capital gearing ratio means what? How much capital in the company, how much capital in the company is having a fixed commitment and comparison that with the equity. Okay, that's why debt plus preference share capital by equity. Debt is a long-term debt. Preference share capital, that is also having fixed commitment. Capital having fixed commitment, one is a pure debt and the one is a hybrid instrument like preference. Both are having a fixed commitment of payments or not. Okay, that means this is another way of understanding the debt equity ratio. Another way of understanding debt equity ratio. So debt by equity we have taken. Now we are taking debt plus preference share capital also, because total capital preference share capital is also there. So therefore, capital gearing ratio means debt plus preference share capital plus equity, or divided by equity. But this enjoyment cannot be taken by equity because equity don't have any leverage effect. Yeah, there is no fixed dividend component. Dividend is variable. Next, debt service coverage ratio means what? Every year I need to pay EMI. EMI will have two components. One is interest component and another one is installment component. whether my profits before interest, depreciation, tax, and amortization, okay, is it capable of paying the interest and the installment? Okay, so for that you understand, we have to understand the concept called as a EBIDTA, earnings before interest, depreciation, tax, and amortization. Okay, so those are the profits available to pay the debt commitments. What debt commitment? Interest on debt and the installment on the debt. Completed. So you have to observe these ratios. 2 minutes time. Putting the screen before you. Read the ratios properly. If not, you can take also the snap. Completed. If you don't complete, at least pause the video and see it. Next, activity ratios. Very important for understanding what is the concept, sir. Activity ratios. Activity ratio means it is always linked to turnover. Okay, activity ratios are also called as, okay, activity ratios are also called as turnover ratio. When I say turnover means sales. Always remember, in all turnover ratios, turnover will be numerator. Turnover will be numerator. Capital turnover ratio means what? More discussion on capital turnover ratio I made at the end of this particular document. We will see in the second session of ratios, but as of now, try to understand clearly. Capital turnover ratio means total capital you will employ in the business or not. Yes. Okay. So it will generate a sales. It will generate also sales. Capital turnover ratio means for the total capital you employ, how much sales it is getting generated. Capital employed represents only long term, okay, turnover or sales. Turnover or sales, we have to take on the numerator, the sales. Next, capital employed can be debt and equity, liabilities. If there is a current liability, how to take fixed assets plus current assets minus current liabilities. Fixed assets plus current assets minus current liabilities is also called as what? Working capital. Okay. So the main point is capital employed means equity and debt, also called as the capital is employed. Means what? Raising the capital is one issue, employing in a correct area is another issue. That's called as a capital employed. Capital employed's other name can also be written as fixed assets plus working capital. Okay, so what is capital turnover ratio? Capital turnover ratio means, meaning of capital turnover ratio, turnover ratios to capital employed, everything we will see later. First, basic understanding, primitive. Capital turnover ratio, always turnover ratio, turnover is in numerator. Turnover by capital employed means for the total sales happened, how much capital is employed? Sales 100, capital employed. Say for example, capital turnover ratio means sales. Say for example, 100. Capital invested 70. Capital invested how much, sir? 70. That means the capital employed is in denominator 70. For that 70, there is a sale. For that 70, there is a sale. Or say for example, I invested 1 crore capital. I made 30 lakh rupees sales. Okay. 1 crore capital employed. 30 lakhs I have made this year. How to tell? Sales 30 lakhs divided by 100 lakhs means 1 crore. You will clearly tell that how much of the sales is done with the capital that is being employed in the business. So from the exams point of view, remember the formula. Capital turnover ratio means what? Turnover by capital employed. Next. Fixed assets on current assets. Sales by fixed asset. Sales by fixed asset. Means fixed assets are used to manufacture the product which will be sold or not. So the ratio. Working capital turnover, sales by working capital. Instead of sales by fixed assets, sales by working capital. Next one is the debtors turnover ratio. Next one is debtors turnover ratio. Sale by debtors or sale by average debtor, or you can also take like this. This is only for understanding sake. 4 to 5 very frequently tested in exam. In the problems they will test. Debtors turnover can be of two types. One, expressed in the form of times. Expressed in the form of times means sales by debtors. Sales by debtors. Debtors cannot be more than sales because sales will generate the debtors. Sales 100, debtors 50 means how many times? Two times. Means what you have to understand, it can be expressed in the form of times. Okay, next. Expressed in the form of times. Next one. If you reverse this, instead of writing sales by debtor, if you write debtors divided by sales into 360 or 12, then debtors to the sales means how many times the debtors are to the sales is what we are going to understand. This will be written in the form of periods, means months and days. Stock to turnover ratio also same. Creditors to turnover also same. Always try to understand average should be taken at appropriate places. Okay, just mug up the formula. I'm not going into the intricacies of the formula. From the exam point of view, what is required, I'm only discussing to that extent. Okay, completed. So these are called as activities. Activity ratio, one more time I'm repeating. There are 6 activity ratios. Capital turnover ratio. We will employ capital in the business or not. How much sales are generated with the capital employed? Sales by capital employed to 100. Fixed assets by turnover. Fixed assets turnover ratio. Fixed assets will be used to generate sales. Okay. How much sale is generated by fixed asset? How much we utilized? Okay. Working capital. Fixed assets is one part of capital employed. You can observe capital employed means what? Debt and equity. Debt and equity. Capital employed can also be in the form of, okay, I will invest the capital employed. I will invest the capital employed in the fixed assets and also in current assets. Current liabilities we have to deduct. So first point, I will use the capital employed to finance my fixed assets. I will use my capital employed to finance my current assets less current liability. Therefore, that will be the next ratio, working capital turnover by turnover ratio. Always turnover ratio, numerator should be what? Turnover. So sales by working capital. Debtors. Sales by debtors. Sales by debtors. Sales 100. Debtors 50. What does it mean? The sales is 2 times the debtors. Means cash sale is, sorry, total sale is 2 times the credit sale. Credit sale is 1 rupee, na? Total sale will be 2 rupees. Next one. Or if you want to know debtors velocity means debtors collection period. Debtors divided by sale into 360. We have already done that in the working capital chapter. Stock turnover, same concept. Creditors turnover, instead of taking turnover the sales, we have to take the purchases here. Every other thing is same. Next. Profitability ratio. What is it? Profitability ratio. More discussion on profitability ratio we will understand in the second lecture with a numerical illustration. As of now, let us understand what these are. Previous example, we have taken sales in the numerator. Now profitability, we are taking that into denominator. Profitability, there are 2 types. Sales profitability, capital profitability. Okay. First 3 things you are seeing are on, first 3 things or 4 things, first 4 are totally dependent on sales as a denominator. Next one is a capital profitability. Okay. Gross profit ratio means what? For the total sales you make, how much is the gross profit? Sales 100, gross profit 20 means what? Gross profit is 20% the sales. Net profit ratio, same. Instead of gross, net. Operating profit is EBIT, costing P&L. Okay. Next, COGS. Fifth one and sixth one are very, very important. which I have given a full notes here, but this notes can be explained only by doing one problem in this regard. At that time, I will explain much in detail, but as of now, try to understand clearly. Without that explanation also, you can do the problems if you know the formula. But more I will explain the video number 2. Video number 2 is also a 1.5 hour video, such that it will cover problems part as well. At that time, I will explain really the meaning of what is return on capital employed. Return on capital employed as a formula. Capital employed means what? Debt, equity, both are involved, yes or no? Debt will ask interest, equity ask PAT. Therefore, PAT plus interest in numerator for the capital employed. Return on equity. Equity means not total capital employed, only equity funding. Therefore, PAT only will come in numerator. That's why more explanation in the notes below. This we will discuss with video number 2 with a problem. Okay. Miscellaneous ratios. Earnings per share, EPS, total earnings by number of shares. Dividend per share, total dividend by number of shares. MPS, total market capitalization divided by number of shares. Dividend payout, DPS by EPS. Retention ratio, retained earnings per share divided by number of shares. P ratio, MPS by EPS. All these already covered in the previous chapters. Nothing great. Okay. Now, summarize everything. How many types of ratios are there? Liquid ratios. Current ratio, current assets by current liability. Asset test ratio, liquid assets by current liabilities. Means current asset minus stock. Capital structure ratios, long-term solvency, debt equity ratio, debt by equity. Okay. Propriety ratio. Okay. Propriety ratio means we are going to take the total assets in the denominator. For the total assets, we are going to take the equity. Capital gearing ratio means capital gearing ratio means that capital which is giving a leverage impact, means which capital? Debt, preference share capital. Okay, that will be taken into the numerator part. Hope you understood what I said, right? Next, after that, debt service coverage ratio. Debt service coverage ratio. Debt service coverage ratio represents the total debt installment and interest that you need to pay, that will be coming in the denominator. Numerator we will take EBI DTA. Next, activity ratio. Activity ratio. Activity ratios are also called as a turnover ratio. Turnover will come in numerator. Capital turnover ratio. Capital turnover ratio. Turnover by total capital. Capital employed. Capital employed. Okay. Capital employed means I will employ my capital to purchase fixed assets and current assets. Therefore, separately we will calculate two again. Fixed asset turnover, working capital turnover. Fixed asset turnover, turnover by fixed asset. Working capital turnover by working capital. Debtors turnover, debtors by turnover. Debtors velocity reverse. Okay, debtors velocity reverse means debtors by turnover will calculate, that will be in the number of months. We will do the problem, debtors velocity questions. Okay, same. Sales profitability, gross profit ratio, gross profit by sales, net profit by sales, operating profit by sales, like that all the denominator sales. Capital profitability ratio, this is a different discussion with problem we will do. Return on capital employed, return by capital employed. Capital employed will include both debt and equity. Therefore, return will not include just PAT, it will include PAT plus interest. Return on equity means only equity funding is involved, the numerator will be containing PAT. EPS means earnings per share, total earnings by number of shares, total market value by number of shares. MPS by EPS. DPS means total dividend by number of shares. Dividend payout ratio, DPS by EPS into 100, retention 1 minus payout ratio. That's all. With this, ratios and their analysis is completed. Except return on capital employed, every other thing is completed. And don't think that this is the only end of this ratios discussion. By doing the problems, we will understand the intricate points from the exam's point of view. Second lecture is also a 1.5 hour session lesson. 8 marks is yours in the coming exam. Okay. Thank you.